Hey, everybody. Welcome to this week's Nasdaq Dorsey Wright podcast. My name is Will. I have Ian with me. We're recording this Thursday morning, February 16th, coming out Friday morning, February 17th. Ian, given all that was released this week on the economic data front, I thought we were going to have more to talk about than we do. Still things to talk about, but not as much as I was thinking.
Yeah, it's not a bad thing to not have as much to talk about after the past, few weeks. Several months to say the least. But we have seen some interesting movement in some of the broader kind of indexes. Not too many indicator changes. Some interesting sentiment stuff that we'll kind of dive into. But I think we always kind of kick things off looking at the S&P, and you and I were touching on before this. The S&P's it's up 8% still so far this year. You saw 5 consecutive buy signals on the default chart, 20-point chart of the S&P. Last week, pulled back a little bit, gave a sell signal. Not the end of the world, right? Multiple consecutive buy signals. It's natural to see a little bit of consolidation, especially once we got north of that pretty significant resistance at 4,100, right?
Yeah. I think that's a good point. One sell signal doesn't change a trend. That near-term uptrend is definitely still intact for the S&P chart here. Some other areas on the S&P chart that we were talking about is prior to the beginning of February, which we're still up 1% probably so far in February, given today's pullback. But prior to February, we came in pretty hot for the month. We were pushing towards the top of that trading band, which is just a 10-week trading band. So we were getting a little frothy throughout. So I think it's pretty natural to see a bit of consolidation.
Right. You were saying we were up north like 90% from an overbought and sold. When you look at the history, the weekly history, for those that following along the site, we pull that overbought oversold data every week, the end of Friday, right? For that data, we're at 51% kind of intraday through market movement on Wednesday.
It's very normal.
Right. Yeah. But when you actually go back and look at the daily history, I think is what you were touching on, that we did get a little bit more extended.
Yeah. So daily, you saw it get a bit more extended. Just making the point that some of the consolidation we're seeing now on that chart around the 4,100 level, which was your December highs, as you mentioned, a pretty significant point of resistance, is normal. Still looks to be healthy right now.
Yeah. We got that kind of brief rally up in September, got up to 4,100 before falling down to those October lows. Got back up to 4,100 in December a couple times, right? Yeah. And then fell back down again toward the end of the year, and now finally got back up to that point and broke through it. Nice to see that spread quadruple top breakout, as we would call it there.
Excellent jargon. Something else I'll add to this too is that you're not seeing the VIX really do anything. You're not seeing a lot of panic and fear move into the market. By that measure, I was listening to a podcast the other night, and I think you probably listened to the same one. And I love the line because it was, CPI came out pretty much in line with expectations, a little bit hotter. PPI, producer price index, came out today, also a bit hotter than people were expecting. But like the VIX is not getting out of bed, as they said. It is hanging out on its default chart below its trend line. If you pull up the 1-point chart, it's also still hanging at the bottom of its trading window over the past year. So you're not seeing a big VIX spike or a lot of fear come into the market.
Yeah, and I think we saw a lot of times throughout last year, the VIX, we never saw a massive VIX spike like you might expect in heavily volatile environments. It was a wide but notable range that it kept moving between, right? And I think you can really see that more clearly on that 1-point chart, like you were talking about. We got the VIX pushing up into the upper 30s beginning of last year, and subsequently, and I know we talked about this in some of the written research, but each time it rallied back up higher, it never got back to the same chart high. Each rally in the VIX was just moving a little bit less of a rally than we got, and the lows kind of remained the same really up until this year. Kind of broke back away from that 19 point, and like you said, it's hanging around that 20 level. Hasn't really changed all that much. And that 20 level's kind of consistent with kind of the average level we see if we just go back throughout the full history of the VIX. That 20 level is kind of normal, even a little bit higher than I think 17 is more so the average that we typically see. So it's kind of more normal ranges. Good to see that kind of normalcy come back into the market movement.
Yeah, it's easy to have a lot of recency bias in the markets, especially when you're thinking about volatility moves. I know throughout one point in 2022, you probably have the stat close to heart, but just the number of extreme days, +1%, +2%, down 1%,
49%,
49%. There it is. Yeah. So it's I think people were kind of expecting some of that to keep happening, and the market has relaxed a lot, especially on some of the economic prints over the past couple of weeks.
Yeah, I mean, and so 49% of the days, and for the S&P last year, so a gain or loss of 1%. We were north of 50% for the Nasdaq 100. That's all a gain or loss of at least 1%. Which, I mean, it has to make you wonder. And it's, I mean, right in some of those pieces, is that, can we really call it an extreme day if it's half the days in the year that saw that kind of movement, right? But one kind of interesting point that we typically see is that those levels, when we got to 49 or up to kind of toward the 50%. Typically didn't see back-to-back years where we saw that. I mean, there was some in the early 2000s, some 2008 timeframe, but we might have seen a little bit of carryover into the next year, so maybe higher than the average number of extreme days. But it's typically you're not seeing that for multiple years in a row.
That's a great point. Yeah, and even just on calendar year returns for the market, I know it's rare that you actually get 2 calendar years negative.
Right.
Unless you're in some really extreme market environments, the 08, 09. Actually, 08, 09 wasn't even 07 positive, 8 negative, 9 positive.
Right.
And yeah, like the early 2000s, I think it happened, and then a couple times before that. So great point. Like that.
And I know talking about some other kind of return tendencies. I mean, we're looking at 8% for the S&P. That's kind of in line with what your average return in the S&P. And I know there's
for the whole year,
right? For the whole year. I mean, we're only 6 weeks in.
Yeah.
So hopefully we get some further follow through to the upside. But I know that you were looking at some data that we had a really strong January. Haven't seen as strong as of February, and that's kind of normal, right?
Yeah. So I put this in the report. I think this was earlier this week. Yeah, earlier this week, and I'll put some of these images on the YouTube video for those watching. Of the seasonally strong period. So by seasonally strong, it follows the market adage, sell in May, go away, come back in November. So your seasonally strong period is November through the end of April. November, December, January, February, March, April. February is typically the weakest month of that seasonally strong period. Still positive on average, and it's positive 55-57% of the time.
Just barely positive there, right?
Barely positive
on average.
Yeah. Again, on average, it's about flat, whether you look at median or average returns, both about flat, 0.5% for the month of February compared to your other months, November, December, January, March, all much more positive, where you have well over 1% average and median gains for that month. So it's not uncommon to see some lateral movement, some digestion in February during that seasonally strong period before pushing higher. And then I know there's other chart that actually you made, and I tag teamed off of it. If you look at February's best and worst months, that's also another point to kind of solidify its relative weakness.
Yeah, that you don't see that extreme weakness or extreme rallies come into play as much in February, right? It's just kind of a more muted month that we see generally across the board, and we're seeing more muted movement in the S&P. So it's good to see that kind of returning to the average, returning to the mean.
Yeah, and I don't know how to kind of quantify that and say kind of why that is the case. Maybe it's some
all we do is check price movement. We don't need to say why. So
yeah, you're right. we took a price movement. I know there's some conjecture about maybe it's some tax laws. I mean, January was a huge month for the laggards, one of the best in history, I believe. So that's something to note about February on average. But speaking back to the point, so January was very positive. It was up 6.3%. I have here beginning of January. That was I believe it was going to be your 15th best return. If you're looking at the table, you can tell me wrong, but somewhere around your 15th best January. Interestingly enough, if January was up more than 4%, February was positive 64% of the time. So it improves the batting average, which was 57%. If January's up at least 5, February was then up 64%, and your average gain was about 1%.
Which we're at about
right now. Yeah. So really strong January. You typically see that follow over into February.
Just not as strong.
Just not as strong.
Yeah, that makes sense.
As strong.
And I know, that strength in January continue over into at least from that weakness in February. That's helping out. I know we want to dive into some of the general sentiment. People have a better feeling about the way things are typically now and you see that reflected in some of the broader market movement. We were kind of expecting some different economic prints over the course of the past couple of weeks. You're not seeing the same swings that you were seeing in this year that you saw last year, and I think that's reflecting some of the sentiment readings too.
Yeah. These sentiment readings, take them with a grain of salt. You typically see sentiment follow market performance. So market starts doing really well, people get more bullish. Market starts softening, rolling over. People tend to get a bit more bearish. So a couple that we look at, and that's really just kind of common in industry, mainly for contrarian and indicators like the AAII, the American Association of Individual Investors. their recent sentiment came out actually on Thursday. So yesterday, 34% of respondents were bullish, and then 29% were bearish. For context, the week before, 38% of respondents were bullish. So a slight downtick in bullishness, but that's still some of the highest readings you've seen since, I believe, November of 21 or late 2021 in terms of bullishness on the market. I don't think it's a coincidence that came after we got a 7%, 8% rally so far.
It definitely contributes to how people feel about it.
Yeah. And
I mean, we've seen some of that individual moves tick up a little bit too. I mean, like AII, looking at individual stock movement. I mean, you got 74% of S&P 500 stocks in a positive trend. That's going to contribute to some of that
high too.
It is, that PTSPX indicator, 74% creeped up to a new 52-week high for that. So, I mean, that's also going to contribute to your positive sentiment, positive feelings from investors.
Yeah. These sentiment surveys and the data shows this are really most helpful at market extremes. You see a lot of market inflection points correspond when you get extremely bullish or exuberant sentiment, and same thing with when sentiment gets washed out. I do wonder, I was talking with you about this before, who these respondents are. I don't think it's a lot of young 25, 30-year-old investors that are taking these surveys every week. I don't know. That's just a question. If you're listening out and know the answer, let us know. We would love to find out.
Yes, for sure.
Some other sentiment things that we like to talk about. Actually, we don't talk about this much, but I think it's interesting. It's the NAAIM. That's the National Association of Active Investment Managers.
We like our acronyms. That's what.
Yeah, we thought we liked the acronyms, but these guys love the acronyms.
Right.
Shout out to the acronyms. The Fun Score podcast last week, I gave that a listen. Highly recommend that. Steve's got a lot of good stuff to share. Always does. But back to this. So the National Association of Active Investment Managers, that's another sentiment, if you want to call it, type survey, that they are reporting the average exposure to U.S. equity markets reported by their members. More specifically, their members, I'll read this from their website, are active money managers who are polled every single Wednesday. And
similar to the
similar to the survey, but they're polling the U.S. equity exposure. That hits, if you want to guess, 84%, which is your highest chart reading since January of 2022, not 2002, 2022. So again, a lot of participation, a lot of kind of optimism coming back into the U.S. equity space is the point there.
Yeah, and I think, I mean, we've seen that in some of the indicators reflected too, that we just continue to see, like we said, the PTSPX tick higher. You look at the group scores page, I mean, the U.S. equity core percent rank, 91%. So, I mean, it's beating most other areas in the global investable universe. I think it's interesting, though, that you did mention with that survey, they're looking at focused U.S. exposure.
Right.
I wonder what it would look like on the international side of things. Because, I mean, we've seen we've seen a lot of the relative rankings and different kind of indicators on our site showing continued strength in international. I mean, you think it can't keep going higher, and then it keeps going higher from an indicator perspective. We were talking the Europe group on that group scores page, 134 different classifications we look at. Europe equities are fifth out of 134. I mean, that's very rare that you see it score that high. It hasn't scored that high from just a broader score perspective. Ever scored 3.92, highest in 5 years. So I mean, it's we're seeing that kind of consistency of improvement. Just not go away for European equities. It's not just a January story; it's continuing. Right?
Yeah, I would like to see some allocation surveys to international equities, because it seems like with a lot of the people that we talk to, it's look, a shiny object. They note it, but they don't really put money where their mouth is, or they don't put the money and actually follow through. And a lot of that actually happens in the sentiment. I'm kind of glad I mentioned that, because people say and do different things. They'll say they're bullish, or they'll say they're bearish, but they're still buying the dip every time the market goes down 5%. So, that's a great point about international. Still very strong. I'd be curious what the sentiments there are like.
Yeah, I mean, I think there's a lot of different indicator stuff that we'll continue to kind of keep an eye out for, and stuff that we're continuing to monitor. But I mean, as we touched on, I mean, there hasn't been a ton of other broader. We've seen those themes in January kind of remain the same. I mean, at the end of the day, it's kind of what you want for trend following perspective. I mean, you want those trends to kind of remain intact and kind of keep going. And so whenever we don't have a massive indicator thing to look toward, it's kind of almost a good day, because you're seeing that consistency of movement.
What's that quote? Is it like bad news is a headline, gradual improvement is not.
Yeah.
Is that what it is?
Yeah.
Something like that.
I mean, we used to do with all the magazine article headlines that, I mean, it's seems like people are talking to strengths for magazine articles these days. Unless we want to have a whole podcast about Chinese balloons or something like that, there's not going to be a ton for us.
Podcast 2 weeks ago.
Right. But yeah, I think other than that, I mean, there's a lot of stuff that we're going to continue to monitor. There's a few kind of indicators that we're looking at for the S&P. We mentioned kind of backed off from overbought territory. Some of that European international stuff still in overbought territory. Kind of like to see that consolidate a little bit for those kind of looking toward that space. It's definitely one thing that at least I'm on the international side looking, keeping a pretty close eye on there. But I mean, with that, well, I think that kind of wraps up most of what we were looking to touch on here today. Unless you had anything else.
I don't have anything else.
Perfect.
Yeah.
Well, with that, I mean, I think, thanks for having me join you here, Will, and thanks for everyone tuning in this week. And we'll circle back to talk to you again next week.